As we have mentioned before, the dividend discount model really only works for us, or we're only able to get it to work for us when we can forecast the dividends with some reasonable degree of accuracy. If you've got a company that's dividends are extremely erratic, or it's not paying any dividends now, and you don't anticipate it starting to pay dividends for a number of years, then you can't forecast those dividends to be able to use the dividend discount model. So we've got to come up with something else. What else is there that we might be able to forecast? Well, there's a very important metric called free cash flow that we're going to use, and we're going to discount that rather than dividends. Now, we're going to spend quite a bit of time later on in this course understanding and looking at how we determine free cash flow. But basically, free cash flow is cash that is available to go to the stockholders and the bondholders after all other expenses have been paid. So in other words, we sell our products and our services, and we get some revenues. Okay, from that we pay our suppliers, our cost of goods sold. We pay our electric bill. We pay the rent. We pay the employees. We pay all of our bills, and now we've got a hunk of money that is available to pay the interest to our bondholders. Okay, to pay our debts, and to also provide some money for the stockholders. That is free cash flow. Free cash flow is money that is available to pay the stockholders and the bondholders after everything else has been paid. And hopefully, a company has some free cash flow. If you don't have free cash flow, if you can't project free cash flow at any point in time in the future, you're not going to be around as a business too long, because it means you don't have enough money to be paying your debts. Okay, because it includes money that has to go to your bondholders, and so if people are lending you money and they can't project when you're going to be able to pay it back, we've got some problems here. So we're going to, in our second method to evaluate the value of stock, we're going to discount free cash flow. Okay, the first one we discounted dividends. Now we're going to discount free cash flow. So it's got a lot of similarities in that extent. To that extent. So let's take a look at our whiteboard, and we'll show our example on this. Now, later on in the course, we will see at how we project free cash flow. But for right now, we're just going to tell you what the free cash flow projections are. And this is on page 5 of your class notes here. So we are standing here at time 0. And at time 1, we are projecting that this firm, okay, this firm, GreenWave, GreenWave is going to have $1 million of free cash flow out there at time 1. Okay, so in other words, after it has paid its employees, it's paid all of the expenses, the electric bill, the rent, all that stuff, it's got $1 million available to pay the bondholders and hopefully give something to the stockholders after that. We think at time 2, the free cash flow is going to be $1.5 million. And that's as far as we're going to project. We're only going to project free cash flow out for 2 years in this particular example. Then we're going to say that starting at after year 2, we think that the free cash flow is going to be growing at a rate of 5% per year forever, just like before. So we're going to get a terminal value for the free cash flow. The terminal value is going to be what is it, its value at the point in time where we stop making the individual projections. So in this case, the terminal value is going to come at time 2, okay? Because we projected free cash flow in year 1 and in year 2, and then we made our simplifying assumption. So we are therefore going to say the present value of the free cash flow is going to be equal to this $1 million divided by 1 plus R. And I haven't said what R is yet. R is our required rate of return again, and that's going to be 9% is what we're going to use here. So it's 1 million divided by 1.09 plus, now we get this 1.5 million up here at time 2. We got to discount it back to time 0. So it's going to be 1.5 million divided by 1.09 squared. And now what we need to do is we need to find what is the present value of the terminal value. Well, what is the terminal value? The terminal value, okay, at time 2 is going to be equal to the free cash flow at time 3 divided by R minus G. Well, what's the free cash flow at time 3? It's going to be 5% more than 1.5 million. So we got 1.5 million times 1.05. That's my free cash flow at time 3. Divide that by R minus G. R is 9%, and G, my growth rate, is 5%. So that's 0.09 minus 0.05. And there it is. There's my terminal value at time 2. 1.5 million times 1.05 divided by 0.09 minus 0.05. That's my terminal value at time 2. Now that terminal value at time 2 needs to be discounted from 2 back to time 0. So that gets divided by 1.09 squared. So the 1.5 million times 1.05, that's my free cash flow at time 3. Dividing that by 0.09 minus 0.05 gives me my terminal value at time 2. And then I've got my terminal value at time 2 gets discounted 2 time periods back to time 0. So I divide by 1 plus R to the second power. So this, I need to do the math on that to find the present value of the free cash flow. Now, the present value of the free cash flow, if you do the math on that, is going to be $35,321,101. And I just rounded it to the nearest dollar there. Let's go back to our class notes here, okay? And we're going to see what is the step that we need to take next. Okay, so the next step here is the free cash flow. This is the present value of all the money that is available for both the stockholders and the bondholders. Now, our goal of this exercise is to be able to come up with a price of the stock. So if this is the money that's available for the stockholders and the bondholders, what I have to subtract from that is the value of the debt. In other words, this is the enterprise value. We talked about that before. The enterprise value is the value of the stock plus the value of the debt. So this is the value of the stock plus the value of the debt. Now, you're supposed to subtract out the value of any, or the amount of cash you have on hand. But let's assume there's 0 cash on hand. If there's 0 cash on hand, then this is the enterprise value of the firm. It's the market value of the equity plus the market value of the debt, because it's the present value of everything that goes to the debt holders and everything that goes to the stockholders. So if our goal is to find the value of the stock, we have to subtract from this the value of the debt. Well, that was given to us here in this problem right there. The market value, not the book value, the market value of the debt was $3.9 million. So if this represents the market value of the stock plus the market value of the debt, when we subtract from it the market value of the debt, what we're left with is the market value of the stock. So there is the present value of all the cash that goes to the stockholders. Now, that's all the cash that goes to the stockholders, and it goes out, of course, on a per share basis. So we need to divide that number by the number of shares outstanding, the number of shares that are out there. So for Freeman right here, I'm sorry, for GreenWave, we've got 1 million shares of common stock outstanding. And by the way, we're only going to have common stock in this class. We're not going to worry about preferred stock. And so we take that market value divided by the number of shares outstanding, and that's going to give us the price per share. So now we have got what we believe should be the price per share of the stock based upon discounting not dividends, but discounting free cash flow. Now, free cash flow goes to both stockholders and bondholders. Dividends only go to stockholders. So when we discounted dividends, we didn't need to subtract out the value of debt because the dividends only go to stockholders. But free cash flow goes to both stockholders and bondholders. So we needed to subtract out the value of the debt. Also, Dividends are already on a per share basis. So we didn't need to divide by the number of shares outstanding. Free cash flow is not on a per share basis. So we needed to divide by the number of shares outstanding, which we did when we got $31.42 per share. Now, what happens at this point in time if you look at the stock and you say, hey, it's trading for more than $31.42? Then you say, well, I think it's overvalued. How about if it's trading for less than $31.42? Well, then you say, I think it's undervalued at that point in time. Now, that's going to lead you to a conclusion of whether you think you should buy the stock or whether you should short the stock. Shorting the stock, we haven't really talked about that, have we? Tune into the next video where we will do two things. We will talk about how you short stocks and what it means to short a stock. And we'll talk about the last method of valuing stocks, which is using comparables.